Let me ask you something that might make you uncomfortable. When was the last time you actually calculated what inflation is doing to your savings account? Not the official number they tell you on the news. The real number. The one you feel every time you go to the grocery store, every time you pay your insurance premium, every time you look at your energy bill. Because while you've been watching your savings account grow by maybe 1 or 2%, something else has been happening, something that most people are completely missing. And it's happening right now, in real time, and it's going to determine whether your savings actually protect you or slowly bleed you dry over the next decade. Gold just did something it hasn't done in years. And I'm not talking about hitting a new all-time high, though it did that too. I'm talking about the way it moved, the velocity, the conviction behind the buying, the sheer volume of capital flooding into physical metal, while most retail investors are still debating whether they should buy more index funds. Here's what nobody's telling you. In the last 18 months, central banks around the world have purchased over 2,000 tons of gold. That's not a typo. 2,000 tons. That's the highest level of central bank buying in over 50 years. And these aren't small countries hedging their bets. We're talking about China, Russia, India, Turkey, Poland. Major economies with sophisticated financial systems and access to every investment vehicle on the planet. So why gold? Why now? And more importantly, what do they know that you don't? Let me take you back to a moment in history that most people have forgotten. It's August 1971. President Nixon is about to go on television and make an announcement that will change the global financial system forever. He's going to close the gold window. He's going to tell the world that the United States will no longer convert dollars into gold at the fixed rate of $35 per ounce. Now, if you weren't alive then, you might not understand how shocking this was. The entire post-World War II economic order was built on the Bretton Woods system. Every major currency was pegged to the dollar, and the dollar was pegged to gold. It was the foundation of international trade, the bedrock of monetary stability. And Nixon just ended it with a single television address. What happened next? Gold went from $35 an ounce to over $800 by 1980. That's not a 20% gain. That's not even a 100% gain. That's a 2,200% increase in less than a decade. People who understood what was happening, who saw the writing on the wall, who moved their wealth into gold before the crowd figured it out, they didn't just preserve their purchasing power, they multiplied it 20-fold while everyone else watched their savings evaporate in the stagflation of the 1970s. Now, I'm not saying we're in 1971 again, but I am saying that something equally profound is happening right now, and most people are going to miss it until it's too late. Look at what's happening in the currency markets. The dollar's share of global reserves has dropped from 73% in 2001 to under 58% today. That might not sound dramatic until you realize what it represents. Trillions of dollars that used to sit in U.S. Treasury bonds are being moved into other assets. And a significant portion of that is going into gold. The BRICS nations, Brazil, Russia, India, China, South Africa, they're not just talking about creating an alternative to the dollar anymore. They're actively building the infrastructure. They're settling trade in their own currencies. They're accumulating gold at a pace that would have been unthinkable a decade ago. China alone has officially added over 400 tons to its reserves since 2022. And most analysts believe the real number is much higher because China has a history of underreporting its gold holdings. But here's where it gets really interesting. While central banks are buying, Western investors are selling. The gold ETFs, the paper gold that most retail investors own, they've seen massive outflows, billions of dollars leaving these funds. And at first glance, you might think that's bearish for gold. You might think, well, if investors are selling, the price should go down, right? Except the price isn't going down. It's going up. Significantly. Gold hit $2,800 an ounce recently, and it's holding those levels despite the ETF outflows. How is that possible? Because there's a fundamental difference between paper gold and physical gold. When you own shares in a gold ETF, you own a claim on gold. You don't own the actual metal. You can't take delivery. You can't hold it. You're trusting that the fund actually has the gold it says it has, and that in a crisis, you'll be able to convert your shares into cash at a fair price. Physical gold is different. When you own physical gold, you own the actual asset. No counterparty risk, no trust required, no middleman who can freeze your account or change the rules. And right now, there's a massive divergence happening between the paper gold market and the physical gold market. The COMEX, the major commodities exchange where gold futures are traded, it's showing something remarkable. The amount of physical gold available for delivery has been dropping steadily. We're talking about inventories that have fallen by over 40% in the last 2 years. Meanwhile, the open interest, the number of contracts that could theoretically demand delivery, it's near all-time highs. Do the math. If even a small percentage of those contract holders decided they wanted physical delivery instead of cash settlement, the entire system would seize up. There simply isn't enough physical gold in the COMEX warehouses to satisfy that demand. And the people who run these markets, they know this. That's why you're seeing premiums on physical gold coins and bars running 5 to 8% above the spot price. That's why delivery times have stretched from days to weeks. The market is telling you something. It's screaming at you, actually. Physical gold is becoming scarce while paper claims on gold are abundant. And in any market, when the physical asset becomes scarce relative to the paper claims, you get a squeeze. You get a repricing. You get a moment where the paper price has to catch up to the physical reality. We saw this in the silver market in 2021. Remember that? Retail investors figured out that the paper silver market was massively leveraged, that there were far more claims on silver than actual silver available. They started buying physical metal and demanding delivery. The premiums exploded. Dealers ran out of inventory. The U.S. Mint had to ration silver eagles. And the price of silver shot up 50% in a matter of weeks. Now imagine that happening in gold, except gold is a much bigger market, much more important to the global financial system, much more sensitive to geopolitical tensions and monetary policy. If we see a squeeze in the gold market, if we see a moment where the paper price has to adjust to the physical reality, we're not talking about a 50% move. We're talking about something much larger. And here's the thing that should really concern you if you're relying on savings. The traditional safe havens aren't working anymore. Bonds? The bond market just went through one of its worst years in history. If you were holding long-term treasury bonds, you lost money. Real money. Not just relative to inflation, actual nominal losses. Cash? Your savings account might be paying you 4% if you're lucky. But real inflation, the inflation you actually experience in your daily life, it's running much higher than that. Housing costs are up double digits. Food prices are up double digits. Energy costs are volatile but trending higher. Insurance premiums are skyrocketing. Your 4% savings rate isn't keeping up. You're losing purchasing power every single day. Stocks? The stock market is at all-time highs, sure, but it's being driven by a handful of mega-cap tech companies. The average stock is actually down from its peak, and valuations are stretched to levels we haven't seen since the dot-com bubble. The Shiller P/E ratio, which looks at inflation-adjusted earnings over a 10-year period, it's in the 97th percentile historically. That means stocks have only been more expensive 3% of the time in the last 150 years. So where do you go? Where do you put your wealth if bonds are risky, cash is being debased, and stocks are overvalued? This is where a lot of people are looking at gold differently than they used to. Not as a speculation, not as a trade, but as a foundational asset, as the thing you own to preserve purchasing power over long periods of time, regardless of what happens in the financial markets or the political system. And if you're sitting on a significant amount in retirement accounts, $100,000 or more, there's actually a way to get physical gold into those accounts without triggering taxes or penalties. I put together a free guide on how gold IRAs work. It's in the description below, covers the mechanics, the rules, the things you need to know. Worth checking out if that's relevant to your situation. But let me get back to why this matters right now. Because timing is everything in markets, and there are specific catalysts on the horizon that could accelerate this move in gold. First, the Federal Reserve is in an impossible position. They've got inflation that's still running above their target, but they've also got an economy that's showing signs of weakness. Unemployment is ticking up. Consumer spending is slowing. The yield curve has been inverted for over a year, which historically predicts recession. So what do? If they keep rates high to fight inflation, they risk triggering a recession. If they cut rates to support the economy, they risk reigniting inflation. It's a no-win scenario, and the market knows it. That's why you're seeing gold rally even while interest rates are elevated. Normally, higher interest rates are bearish for gold because gold doesn't pay interest. But right now, the market is looking past the current rate environment and pricing in what comes next. What comes next is probably more money printing, more quantitative easing, more fiscal stimulus. Because that's what governments always do when they're faced with a crisis. They print money, they bail out the system, they kick the can down the road. And every time they do that, every time they expand the money supply, they dilute the value of every dollar in existence. Gold doesn't get diluted. You can't print more gold. You can't create it out of thin air with a keystroke. The total amount of gold ever mined in human history would fit in a cube about 72 feet on each side. That's it. All the gold in the world. And we're only mining about 3,000 tons per year, which is less than 2% annual growth. Compare that to the money supply, which can grow 20 or 30% in a single year when central banks decide to open the floodgates. Second catalyst, geopolitical instability. We're living through a period of unprecedented tension between major powers: the war in Ukraine, the situation in the Middle East, the growing rivalry between the US and China, the fracturing of the global trading system. Every one of these conflicts increases the demand for gold as a neutral reserve asset. Think about it from the perspective of a country that's worried about sanctions. If you're Russia or Iran, or any nation that might find itself on the wrong side of US foreign policy, you can't hold your reserves in dollars. The US can freeze those assets with the stroke of a pen. We've seen it happen, but they can't freeze your gold. If you hold physical gold in your own vaults, it's yours. No one can take it away. No one can sanction it. It's the ultimate form of financial sovereignty. That's why you're seeing countries repatriate their gold. Germany brought back 300 tons from New York and Paris. Austria, Netherlands, Belgium, they've all moved gold back to their home countries. They want physical possession. They want control. They don't want to rely on the goodwill of foreign governments or the stability of foreign banking systems. Third catalyst, the mining supply situation. Gold mining is getting harder and more expensive. The easy deposits have been found. The high-grade ore bodies have been mined out. What's left requires going deeper, processing lower-grade ore, operating in more remote and politically unstable regions. The all-in sustaining cost for gold miners is now over $1,300 an ounce on average. Some mines are operating at costs above $1,500. That means, at current prices around $2,800, miners are profitable. But they're not wildly profitable. They're not generating the kind of cash flow that would justify massive expansion. And even if they wanted to expand, it takes 7 to 10 years to bring a new mine online. You have to find the deposit, prove the reserves, get the permits, build the infrastructure, hire the workers. It's a long, capital-intensive process. So, supply is constrained, and demand is accelerating. That's the setup for a sustained bull market, not a quick spike and crash, but a multi-year trend where gold steadily reprices higher as the market realizes that physical metal is scarcer than people thought. Now let me tell you a story that illustrates why this matters for ordinary people, not just central banks and hedge funds. It's 2008. The financial crisis is unfolding. Lehman Brothers has just collapsed. The stock market is in free fall. People are panicking. They're watching their 401ks get cut in half. They're seeing their home values plummet. Everything they thought was safe, everything they thought was solid, it's all melting down. There's a guy, let's call him Robert. He's 58 years old. He's been saving diligently for retirement. He's got about $800,000 in his retirement accounts, mostly in stock index funds and bond funds. He's following the conventional wisdom: diversified portfolio, long-term perspective, stay the course. By March 2009, his portfolio is down to $450,000. He's lost $350,000 in 6 months. He's 5 years from retirement, and his entire plan is in ruins. He's going to have to work longer. He's going to have to cut his lifestyle. He's going to have to hope that the market recovers before he needs to start drawing on those accounts. Now, there's another guy. Let's call him Michael. Same age, same amount saved. But Michael did something different in 2007. He was reading about the housing bubble. He was watching the subprime mortgage market implode. He was seeing the warning signs that most people ignored. And he made a decision. He moved 30% of his retirement portfolio into gold. Not gold stocks, not gold ETFs. Physical gold in a gold IRA. His friends thought he was crazy. His financial advisor told him he was making a mistake. Gold doesn't pay dividends. Gold doesn't grow. Gold is a barbarous relic. All the usual arguments. But Michael did it anyway. And when the crisis hit, when the stock market crashed, when the bond market seized up, gold did something remarkable. It held its value. In fact, it went up. While Robert was watching his portfolio get cut in half, Michael's gold position was cushioning the blow. His overall portfolio was down, sure, but it was down 20%, not 45%. He still had $640,000 instead of $450,000. And then, over the next 3 years, as the Fed launched QE1, QE2, Operation Twist, as they flooded the system with liquidity, gold went from $800 an ounce to over $1,900. Michael's gold position more than doubled. His overall portfolio not only recovered, it reached new highs. He retired on schedule. He didn't have to compromise his plans. He didn't have to work longer or spend less. The difference between Robert and Michael wasn't intelligence, it wasn't luck, it was understanding. Michael understood that the financial system was fragile. He understood that when things break, when trust evaporates, when the conventional wisdom fails, gold is what people turn to. Not because it's a great investment, but because it's the ultimate insurance policy. And here's what's crucial to understand. We're in a similar setup right now, maybe even worse. The debt levels are higher. The valuations are more extreme. The geopolitical tensions are more severe. The monetary system is more unstable. All the conditions that led to the 2008 crisis, they're still here. They never got fixed. They just got papered over with trillions of dollars in printed money. Look at the federal debt. It's over $36 trillion now. That's trillion with a T. The interest payments alone are approaching $1 trillion per year. That's more than we spend on defense, more than we spend on Medicare, just the interest on the debt. And it's growing exponentially because we're running deficits of $2 trillion per year, which means we have to borrow more money to pay the interest on the money we already borrowed. This is not sustainable. Everyone knows it's not sustainable, but no one wants to be the one to say it out loud because the implications are too scary. If we can't borrow more money, if the bond market loses confidence in U.S. debt, if foreign buyers stop showing up at Treasury auctions, then the Fed has only one option: print money, buy the bonds themselves, monetize the debt. And when that happens, when the Fed is forced to choose between defaulting on the debt or inflating it away, they're going to choose inflation. Every time. Throughout history, every government that's faced this choice has chosen inflation. Because default is politically impossible. Default means telling Social Security recipients they're not getting their checks. Default means telling bondholders they're not getting paid. Default means admitting failure. Inflation is sneakier. Inflation lets you pay back the debt with devalued currency. Inflation lets you pretend you're honoring your obligations while actually stealing from savers and creditors. Inflation is the politically expedient choice, and it's the choice they're going to make. When they make that choice, when the printing presses really get going, gold is going to do what it always does in those situations. It's going to preserve purchasing power. It's going to act as a store of value. It's going to separate the people who understood what was happening from the people who trusted the system. Now, I want to be clear about something. I'm not saying you should put all your money in gold. I'm not saying you should panic and liquidate everything tomorrow. What I'm saying is that if you're relying on savings, if you're counting on your accumulated wealth to support you in retirement or provide security for your family, you need to understand what's happening to the monetary system. You need to understand that the rules are changing, and you need to position yourself accordingly. Gold is not a get-rich-quick scheme. It's not going to double overnight. What it is a hedge against the systematic debasement of fiat currency. It's a way to opt out of the monetary experiment that central banks are running. It's a way to protect yourself from the consequences of policies that you have no control over. The central banks understand this. That's why they're buying. The sovereign wealth funds understand this. That's why they're accumulating. The ultra-wealthy understand this. That's why they're allocating significant portions of their portfolios to physical precious metals. The question is, do you understand it? And more importantly, are you going to act on that understanding before the crowd figures it out? Because here's the thing about gold. It's not like stocks where you can buy millions of shares with a click of a button. Physical gold has to be mined, refined, minted, transported, stored. There are physical constraints. There are bottlenecks in the supply chain. When demand surges, when everyone suddenly wants physical metal at the same time, the system can't handle it. Premiums explode. Delivery times stretch out. Dealers run out of inventory. We saw this in March 2020 when COVID hit. The spot price of gold was around $1,600, but you couldn't buy physical gold for anywhere near that price. Dealers were charging $1,800, $1,900, even $2,000 for coins and bars. The premium was 15 to 20% above spot. And if you wanted to buy size, if you wanted to buy 100 ounces or more, you had to wait weeks or even months for delivery. That's what happens when the paper price and the physical price diverge. That's what happens when the market realizes that there's not enough physical metal to satisfy demand. And we're heading into another one of those moments. The signs are all there. The central bank buying, the COMEX inventory drawdowns, the premiums on physical metal, the geopolitical tensions, the monetary instability. The smart money is positioning now, before the crisis, before the panic, before the premiums blow out and the dealers run out of inventory. They're not waiting for confirmation. They're not waiting for gold to hit $3,000 or $4,000. They're buying now at these levels because they understand that the risk-reward is asymmetric. If they're wrong, if somehow the monetary system stabilizes, if somehow the debt gets under control, if somehow inflation comes down and stays down, then gold might go sideways for a while. They might not make money, but they won't lose much either. Gold has held its value for 5,000 years. It's not going to zero. But if they're right, if the monetary system continues to deteriorate, if the debt spiral accelerates, if inflation comes back with a vengeance, then gold could go significantly higher. We're talking about $5,000, $10,000, maybe even higher over the next decade. The upside is enormous. The downside is limited. That's an asymmetric bet. That's the kind of bet that sophisticated investors make. So, let me bring this back to you and your savings. You've worked hard for that money. You've sacrificed. You've saved. You've done everything you were supposed to do. You've been responsible. You've been prudent. And now you're watching the value of that money erode in real time because of policies that you didn't vote for and can't control. You have a choice. You can keep doing what you've been doing. You can keep your money in savings accounts earning 4% while real inflation runs at 8 or 10%. You can keep your money in bonds that are vulnerable to rising rates and default risk. You can keep your money in stocks that are trading at valuations that have preceded every major crash in history. Or you can do what the central banks are doing. You can do what the sovereign wealth funds are doing. You can do what the smart money is doing. You can allocate a portion of your wealth to physical gold. Not as a speculation, not as a trade, but as insurance, as a hedge, as a way to preserve purchasing power regardless of what happens next. The window is still open. Gold is still available at reasonable premiums. Dealers still have inventory. You can still position yourself before the crowd figures it out. But that window won't stay open forever. When the crisis comes, when the panic hits, when everyone suddenly wants physical metal at the same time, it will be too late. The premiums will be prohibitive. The inventory will be gone. You'll be stuck watching from the sidelines while the people who acted early protect their wealth. Don't let that be you. Don't be the person who understood what was happening but didn't act. Don't be the person who looks back in 5 years and says, I knew I should have bought gold when it was $2,800. I saw the signs. I understood the risks. But I didn't do anything. The information is right in front of you. The evidence is overwhelming. The central banks are showing you what they're doing. The market is showing you what's happening. The question is, are you paying attention? And are you going to act on what you're seeing? Your savings are at stake. Your retirement is at stake. Your financial security is at stake. This isn't about getting rich. This is about not getting poor. This is about preserving what you've worked your entire life to build. And right now, in this moment, gold is doing something it hasn't done in years. It's breaking out. It's showing strength. It's telling you that the smart money understands what's coming. The only question left is whether you're going to listen.